Happy Thanksgiving Eve. In my last video, I talked about how a global investment strategy can really pay off in the long run. One thing that I've seen on YouTube is a tendency to mistake the recent decade of outperformance of US equities as evidence that this is just going to continue in perpetuity. As long as the earth shall turn, US equities shall lead. Not necessarily the truth. And actually, you could have been keeping pace with and now beating the most common US 3 fund suggestions I've seen on YouTube with a global investment strategy already, even during the decade of US outperformance. So I've got loaded in here first the Miller Momentum Global Equity. So this is the same relative weighting of the different sectors of the global equity market with a momentum approach layered on top of each of those indices. So you've got SPMO for the S&P 500, you've got XMMO for the S&P 400 mid cap, you've got XSMO for the S&P 600 small cap, you've got IDMO for International Developed Index, and you've got Freedom for emerging markets, which excludes all of the autocratic regime markets and only selects the top 100 equities from the remaining free emerging markets. Next, you've got your 3 fund portfolio that I've seen, uh, you know, bandied about on YouTube. I think there are some variations. I've seen VOOG, and VTV. I've seen VOO, SHOOD, and QQQ, which is a misunderstanding of QQQ being a growth ETF. It is, in fact, not. It's just an index that so happens to, at this point in time, have a lot of tech in it because, again, QQQ is just the top largest 100 US companies that are not in finance. So at a different point in the future, it might be all utilities and energy. Who knows? But anyway, the most common one I've seen is SCHD, often called SHOOD, SCHG, often called SHUG, and VOO. So that's the one we're going to test out here. And this is a concentrated bet on US large caps, I would point out. It's basically a proportional mix of value, growth, and the S&P 500. Um, it's actually pretty functional to just as if you had put everything into the S&P 500, but that's a different topic. And lastly, I'll show my Miller Momentum Balanced allocation, which only does 60% to equities and then 40% to alternative trend following strategies, because I typically in my portfolio include things beyond equities. But I wanted to show you a comparison of equities only approaches and my more standard approach of having a portfolio that goes beyond equities. So let's start the races and assume that you've been adding $1,800 quarterly saving for retirement. Coming down here, well, look what we have. Miller Momentum Global Equity, diversified in relative proportion across global markets, and using that momentum strategy on top of them, beats the US 3 fund. Money weighted return is 18.46%. That's more than 2% more than the money weighted return of the US 3 fund. Volatility is comparable. It's actually slightly less for the Miller Momentum Global Equity. We have a slightly smaller max drawdown. Our Sharpe ratio is better. Our Sortino ratio is better. And look at the beta, 0.92. So compared to 0.99 for the US 3 fund, which is just about as sensitive as the broad market itself. We've reduced a little bit of our sensitivity to the market, so we've generated a lot of alpha, or returns in excess to what we should expect from the market compared to our US 3 fund approach. But here's what I find most surprising: Miller Momentum Balanced, which only allocated 60%, only 60% to the global equity momentum strategy, comes in just shy of about $2,000 from the US 3 fund. So it is neck and neck with the US 3 fund right now if you had started saving in 2019. And so the returns from this balanced approach that has only 60% equities and a beta of 0.55, which means that it is half as sensitive to market movements up or down, so much smoother ride. It's getting you right neck and neck with a US 3 fund. And it's doing that with a volatility of 12.61%. And it's doing that with a max drawdown that is less than 2/3 that of the US 3 fund. And look at the Sharpe ratio, 0.94. That is a really efficient conversion of risk into returns. And the Sortino ratio, which ignores volatility on the upside, only looks at negative volatility, 1.35, which means you're not getting a lot of negative volatility here. I mean, this is really good. And it just goes to show that taking a global look at things and not just performance chasing based on the past decade, thinking strategically can really pay off in the long run, because the US 3 fund strategy is dependent on the United States continuing to bring in just gargantuan returns. Whereas the Miller Momentum Global Strategy is going to keep a high return consistently over time because it'll chase momentum wherever it goes. And it didn't lose out during the decade of US outperformance. It kept competitive. So there's not really, a trade off in terms of significant underperformance during periods of US overperformance. The Miller Momentum Global Equity Strategy and the amount that it allocates to each global market sector is going to change over time. So if the US's contributions to the global market decreases to 40%, if US stocks are only 40% of the market, then we'll adjust that down on an annual basis and set the US equity portions in the global momentum strategy to 40%. If US is 70% of the total world stock market, then we'll bump it up to 70%, but it shifts over time. So you're not going to be stranded if we have a situation like Japan did, where it was a sizable portion of the global stock market and then just shrunk after a big bust and took over 20 years to recover. Miller Momentum Global Equity isn't going to wait that long because it is globally exposed. Again, it's going to chase momentum wherever it goes. Now, I want to show you something else cool. So, if we substitute the Freedom Index here for Invesco's S&P Emerging Markets Momentum ETF, and I've talked about why momentum doesn't really work in its typical form with emerging market indices, because you have to exclude the autocratic regimes. You have to only focus on the free markets for it to really work. But anyway, I'm going to pick it because it's not great. It often underperforms. So we've got 10% allocated to something that underperforms a lot. Well, not always. I mean, it has dipped above the emerging markets index, but it's not a standard stellar performance I would expect. Anyway, this will allow us to go back 10 years and see what happens. So let's see what happens. Once again, we are neck and neck But the Miller Momentum Global Equity Strategy is slightly ahead of that US 3 fund by about $2,000. The money weighted return 15.46% to 15.31%. The max drawdown is just a hair worse than the US 3 fund, but again, it's just negative 33% pretty much. And the volatility is slightly improved for Miller Momentum Global Equity. Now, what's interesting here is that the beta for Miller Momentum Global Equity is 0.87. So we've actually improved our beta a little bit and kept a slight outperformance over the US 3 fund with that continual contribution strategy. Now, to get a more accurate sense, we can get rid of the EEMO, increase IDMO up to 40%, and get a better approximation of how the Miller Momentum Global Strategy would have worked if freedom had been available 10 years ago. Here, you see an even more pronounced outperformance. Miller Momentum Global Equity is now up at 16.19% money weighted return. The max drawdown is lower than the US 3 fund. The volatility is lower than the US 3 fund. It's got a beta of 0.86. It's just giving you really good all around returns. It's beating the US 3 fund, even considering this most recent decade of outperformance of the US market in general. And you are avoiding the risk geographically that the US 3 fund gives you, in that if it depends on the US continuing to bump up its GDP and other economic indicators. Miller Momentum Global Equity Strategy doesn't have that same geographic risk for you. So thank you so much for watching this video, especially over your Thanksgiving holidays. I hope that it is wonderful. I hope that you and your loved ones have lots of turkey and make lots of memories together. And again, nothing here is financial advice. It's just me showing you the stats and the data. I will catch you next time. Take care, y'all.